Welcome to Ask the Expert in a Crisis, where we ask industry leaders about their unique perspective on how to navigate the most difficult challenges faced by the broader real estate and financial services ecosystem during the current global health crisis. Also giving you a chance to ask the expert some of the most pressing questions on your mind. My name is Max Simkoff. I'm the CEO of States Title. Today, I'm excited to welcome founder, president, and CEO of CMG Financial, Chris George, who's going to be talking with us about the topic, how will COVID-19 affect the loan process that is managed by mortgage originators. Just some quick background on CMG and Chris. The company was founded in 1993. CMG is a well-capitalized, privately held mortgage banking firm that makes its products and services available to the market through three distinct origination channels. Those include correspondent lending, wholesale lending, and retail lending. Chris reminded me right before we began that since founding in 1993, CMG has grown to be over 2,000 associates today, which is really remarkable, and we'll be talking more about their growth and development. Chris himself, as CEO, president, and founder of CMG Financial, has spent 3 decades building an organization capable of sustaining and thriving through a number of challenging market fluctuations, including the current one that we're in. He serves as immediate past chairman of the Mortgage Bankers Association. He's a member of the MBA's board of directors, past chairman for the California Mortgage Bankers Association, and a member of the CMBA's board of directors, and has also served on many advisory boards and task forces within the industry. So I would be hard pressed to think of anybody on this webinar who probably doesn't know Chris or isn't aware of them, but in case not, that's the background and bio. Just a couple notes before we begin. If you have a question for Chris, we'll be taking those after the first 15 to 20 minutes or so of discussion. Those can be submitted via the Q&A text link at the bottom of your webinar window. And lastly, this webinar is being recorded and will be available on the States Title website afterward. If you have additional future topics or interviewees for the program, you can reach out to us at events@statestitle.com. So Chris, welcome. Thank you for agreeing to spend some time with us today.
Oh, you're very welcome. It's an honor being here with you, Max. I've always enjoyed our conversations and also just loved watching both from afar and close the success of States Title. So thanks for having me here. Awesome.
Let's start with just a little bit of perspective and background, given the success you've had growing CMG. Now, over 20 years ago, you founded with a small team of just 7 people. And as I mentioned in the intro, now over 2,000 employees. I'd love to, at a high level, start with understanding what characteristics that you found to be most important in helping you build the business successfully, and also through, certainly some challenging ups and downs in the mortgage cycle.
Well, that's a great question. So if you rewind a little bit in my career, I started in the mortgage industry in 1982. I was actually 19 years old. And at the time, this wasn't, like almost all of us, hardly any of us thought this was going to be the direction of my career. I'm going to, go in the mortgage industry. It tends to kind of pull you in, and I think we're all accidental, mortgage participants at some level or another. And by the time 1988 rolled around, I kind of thought I wanted to start my own company. And the reason was I just didn't like culturally the way certain companies treated their employees. And so I thought I could do it better, and I'm going to go start my own company. And I did that in 88. I was a plain old mortgage broker, started in my 4th bedroom at my home in Dublin, California. And suddenly decided that I wanted to grow, and sold that company and started CMG in my garage, as you mentioned, with 7 other people. A couple of 2, 3 are still with us today, so been around a long time. And what's interesting is that I've been asked a variation of this question before. So my whole thing when I started out, in my heart of hearts, I'm a loan officer. I think like a loan officer. I like the value proposition of a loan officer. I like how loan officers serve and are able to get what the customer is looking for and don't get paid unless they do. So I really like all of that. So I like that. I embody many of those qualities. And so when I first became a loan officer, I was really not all that focused on making money. I was really just focused on the person liking me. And to be honest with you, I didn't even care if I made money. I just wanted you to think I did a good job. I guess I had maybe a little inferiority complex back then. But what's odd is that accidentally, I discovered the secret of almost all sales organizations, and that is if you can get your customer to like you so much that they become your primary referral source, then that just continues its way down the path. So you liked me and you referred me to two of your friends, they loved me and they referred me to two of their friends, and along the way suddenly I started actually making money. But early on I would do loans for free because I just wanted you to go, oh my gosh, he's amazing. So with that in mind, I didn't want to lose this culture of helping and teaching and educating. Both my parents were teachers. I have a number of teachers in my family, brothers and sisters and uncles and aunts and cousins. And I really wanted to make sure that I give you the information to make an informed decision. So from my perspective, I thought, okay, if I make these people really like me and they come away informed, that is the culture I'd like to have permeate within our organization. Externally, everyone that interacts with CMG, we elevate them to the level of being a customer. Internally, we do some things to make sure that we are super supportive of our people. And I'll give you one quick example. We do all those trade, Stratmore studies where we compare our information with other companies. There's one area that we're always the number one in, and that's what we spend for benefits on behalf of my employees. We're the most expensive. We're the company that spends more money on benefits for employees than any other company in my peer group. And it's a big difference between number one and number two. What that does is my employees come to work and they'll frequently say, oh my gosh, I came to work here. My benefits are substantially cheaper to me as the employee than what it was at my previous company. So much so, I'm able to buy a car, I'm able to pay off other debt, what have you. So we felt like that was a good way to put our, quote, money where our mouth is, and by able to deliver it on the promise of there's something different going on culturally and our company's personality. What has that done for us? Well, there's a lot of stickiness. We don't lose a lot of people. Industry average is somewhere between 20 and 25% of your production goes away every single year. Over the last 3 years, we've averaged somewhere right around 8.5 or 9%. So we're way lower than industry average. One of the ways that we do that, and I'll let you get on with your questions, but we have a series of CMG-isms, and one of them is called leapfrogging. So anybody in the company can call anybody in the company, you don't get in trouble. And if you want to call me because you have an obstacle or an opportunity, I'm happy to jump in and help. So that goes all the way to a VA loan, where the borrower turns out to not be a veteran, to a loan where we're trying to make a loan on a piece of property that's an island, all the way to we made a loan to a barn that is a condo. A barn dominium is what it's called. I've never heard of one of these things before. But it was one of those things where it was a really good customer and it made sense. It was the right loan to value. It was a good borrower, and it got to my desk. And I still am at a loan level basis because I think that's what keeps us nimble and agile and informed. And I think it permeates again to who we are as a company. No bet is too hard for us in terms of going the furthest we need to go to make the customer's experience extraordinary, and that's every customer, every time, no exceptions, no excuses mentality.
Yeah, that's great. I mean, helping your customers, treating your people well, they sound like truisms, but they're the foundation of building successful companies. My father-in-law always loves to remind me that Sam Walton and his wife would go and work the cash register at Walmart, every weekend, when they were building the business up until they were unable to basically walk into a Walmart location anymore. And I think kind of a funny aside is that Sam Walton, part of the reason he did that is he felt like the only way he could get customer feedback was making sure that he was talking to the customers himself. Let's switch gears a little bit to something that's very recent and also in the realm of perhaps making things a little bit more challenging for both customers and your loan officer associates that just got announced yesterday. And I'm going to read you two headlines from two different publications. I won't tell you which is which publication because I think it's fascinating how this is getting reported, but I would love to get your take on this. The first headline is borrowers face new fee to cover heightened risks. The second headline is refinancing your mortgage will cost more thanks to a new fee from Fannie Mae and Freddie Mac. And both of these obviously referring to an announcement from Fannie and Freddie yesterday that after September 1, it's going to include what's called a new adverse market refinance fee of 50 basis points of total loan value on refinances. And so a couple different questions here, not to put you on the spot. One is, what is this fee to the, I mean, of what we know about it, given that it was only announced less than 24 hours ago, like, is this really a fee to protect against risk that is being, new risk that is being introduced in the market, or is it something else? And this kind of gets into the theme of the discussion in general, like, what do we do about this, and are we going to see more of this? Like, is this kind of the new normal of kind of new hurdles that are being introduced to how we originate loans and help homeowners during a very challenging time?
Well, okay, so let me respond to that in a couple of fronts. First of all, the fee is not good for the industry. It's not good for a time where people are suffering through a variety of different setbacks associated with the coronavirus. There's just no question about that. You're talking about an implication or an implementation of a tax on refinances, which almost makes you wonder, well, okay, so if this is some form of risk, an arbitrary change in G fees should, when you raise G fees, should reflect real risk. And so I'm not completely convinced that there is real risk yet based on the data that we have with regards to the number of forbearances and how many folks are going to be able to afford their payments in the future as it relates to the continuation of shutdown in a lot of the economy across the United States. Because there's some areas that are coming back and there are other areas that just are not. And there's a starting and stopping of and raising and lowering of the amount of folks that are testing positive for the coronavirus. The big thing is we just don't know what we don't know. So in my opinion, when you don't know where you don't know, and what you don't know, it's sort of like driving with your eyes closed. Now, I wouldn't recommend doing that, right? But if you're going to do it, I would highly recommend you do not jerk the wheel to the left or the right arbitrarily. I would think that driving with your eyes closed, you're probably better trying to keep the wheel reasonably straight. And I think this is one of those arbitrary jerks. And I'm not specifically referring to anyone individually. I'm talking about the action. And so as a result, I think that you should really sit down and say, are we going to see higher default costs due to the coronavirus? And if so, what are those costs? And if those costs result in a 30, 20, 50, 70, 60 basis point change. So industry should come together and make a decision on this thing. So there's the fee itself, right? What is the fee? What is it taking care of? And what will it do in terms of protecting both the agencies for increased risk? So there's that. Equally is the implementation of the fee. This is a 2-week notice of a fee with people who have billions of dollars worth of pipelines locked all around the United States. And by the way, there's precedent on how these fees have been implemented previously. So I do not understand why the director has chosen to go about making this fee implemented the way that how they've come up with the fee and implementing it the way that they are implementing it. And I am certainly not making the recommendation or suggestion that we ought to have this fee extend past refinances, but make this argument. How do you make an argument of a rate term refi at 45% LTV with a 9 DTI and a 780 FICO is somehow more risky than the 97% loan to value first time home buyer that's got a DTI that's higher than the other customer and probably a credit score that's lower than the other customer? So if one of those two were going to weather the storm of losing your job, clearly the person that's got a lower DTI, higher credit, lower loan to value has a lot more opportunity to weather the storm than somebody that's right at the edge in each one of those categories. And again, I'm not suggesting put a 50 basis point tax on purchases, but I am saying to you that it doesn't seem terribly well thought out. And I wish industry was more part of the collaborative discussion. Nobody likes this, right? Nobody likes a fee. And to the degree that if interest rates stay low in the low threes, maybe nobody even notices it. But it did push pricing back a little bit. If you take a look at what pricing was back in maybe April or May, we're probably back there now because this 50 basis points is something that's going to be part of the process of the expense for a customer to refinance. I'm hopeful what you'll get I mean, ideally, I'd like them to pause and say, let's think about this. I'm not completely convinced that's what's going to happen. So what I hope happens is there's a delay of implementation. And so there's a process to which people can clear out their pipelines, a process to which this can get integrated into all the pricing systems, et cetera. So it's not just so quickly pushed through that it creates havoc in the marketplace.
Yeah, or even, I mean, I think what was striking to me a bit, and granted, this is, with all new information, so we'll see what comes out in the next few weeks or months, but might there even be a way to, if they were going to keep this fee, maybe direct it at encouraging some of the things that, it is at least being communicated as being designed to protect against, right? So like, it's a little unclear to me, is like, is this fee going to mean that there's more cash sitting on the balance sheet of the GSEs for a rainy day, which is certainly, that's one thing that it could be used for, or might it be used to encourage more first-time home ownership, or might it be used to, enable some other programs that keep the necessary liquidity in the system that we need? And I wonder, and you've had certainly way more experience at this than I have. Is that the kind of dialogue that you think could be opened up now that it's been established as something that they're going to do? Might there be dialogue around, well, if we're going to do this, can we at least have dialogue around how those funds get used kind of for the benefit of the greater good that they're at least being communicated as being designed to protect?
It's kind of like the waterfall. You're describing a classic case of a waterfall. So the waterfall starts with, okay, do we believe that there's going to be greater risk in the future? Is there going to be concern whether or not people can stay in their homes? And if so, is that based in part on fact, unemployment, the continuation of this virus, and on and on? Yes, I think there's a reasonable statement to say that because of forbearance and the other things that are going on, there probably is greater risk. Okay, how much is that risk? And how do we price that risk? So that's the first step. And then when the risk goes away, how do we stop pricing that risk?
Right.
So, okay, the risk is gone. Well, let's just keep, let's keep chugging along here with this tax. And then last but not least, where is that money going? Is the money simply going to the bottom line of Fannie and Freddie so that both of those entities can get out of conservatorship quicker? Maybe. Is the money going to methods to help people weather that storm and get back to making their payments on time? In other words, an increased awareness around modification? Possibly. But none of that is discussed. It's just, hey, look, we're taxing you, and there is no discussion about it. We're simply instigating this fee, and that's it, right? There's no real discussion around it. I don't think that's good for any industry. It's been bad for the mortgage industry because I hardly doubt any individual has ever gotten a decision like that correctly done. I think most people say, we see this, and they're operating with the best intentions, but they are not operating with all of the information. And the way you operate with all the information is you bring in those stakeholders and have that conversation.
Totally. I want to ask one more question before I open it up to Q&A. And I think I've seen at least one come in. And just as a reminder, you can use there's a Q&A button at the bottom of the screen for those of you who have a question for Chris. If you send those in, I'll see it and I can tee them up here in a couple of minutes. I guess getting to the other side of the only way that our industry over time can increase profitability, especially in a world where there may be increased fees, and then ideally pass on some material benefit of that profitability in the form of lower fees to end consumers, is through the widespread adoption of technology. This is something that I think is a relatively uncontroversial topic that nearly everybody in our industry, certainly anybody who's forward thinking, would agree on. And I think certainly what you've seen recently is because of COVID-19, a lot of originators have been scrambling to enable better capabilities around technology broadly, but to be more specific, around this concept of fully remote digital closing. This has certainly been a bunch of conversations we've been having, and as you and I talked about yesterday, and I thought you offered some very good advice for these kinds of conversations that we're having right now. It's like, let's keep it practical. Let's talk about what can be practically done here. You guys have done some things practically that enabled you to be ahead of the curve. You, I believe, have already to some degree implemented e-notes, which are a critical part of enabling you. it's almost like one of the things I've learned is you can't enable a fully remote digital closing unless you've figured out how to implement eNotes. And so on that topic in particular, and then maybe on the topic of enabling the fully remote digital close, what has CMG been able to do, and what have you learned in your experience of trying to move towards a world where you enable a fully digital mortgage that you think is, some practical takeaways for many who are on this webinar who are probably wondering how can they do this quickly?
So we were one of the very first companies, and believe it or not, this was about 8 or 10 years ago, that started doing eNotes. I believe we were the first independent mortgage bankers to start selling eNotes to Freddie Mac and then ultimately to Fannie Mae. And so part of the problem with this is that if you are a typical mortgage banker or a typical bank that is doing mortgages in the entire spectrum, you're trying to get efficiencies via a systemic process. So what happens with eNotes is that if you want to utilize eNotes, and for the sake of discussion, FHA doesn't deploy eNotes today, you're constantly saying, oh, okay, all my FHA loans got to go over here, which is the old way, and all my streamlined eNotes stuff can go over here. Where you really run into problem with eNotes is your remote online notary discussion. And how do I, because I'm still looking at, all right, I can do most of it electronic, but I have to have this person notarize it. And then lastly, there are certain parts of the country that operate, and you know this better than I, but certain parts of the country's county recorder's office operate differently than other county recorders' offices. And the technology that exists within those local county recorder's office isn't the same all the way across the board. Somebody told me that blockchain might help that ultimately into sort of one unified format. What does eNote do? I have been a proponent, and I believe eNote will reduce the cost. I believe that it'll allow me to sell my loans quicker. It'll allow me to not be so dependent on giant warehouse lending, because I can fund the loan on Monday and sell it on Monday. It ought to be like buying and selling a stock. That's simple. So my reliance on mega warehouse banks drops dramatically, because I don't have to have this long duration of keeping the loan until I send it on its way. I think there's a number of several legislative efforts going on about remote online notary. Once we can get that done, and we also can get some of this, I'm very encouraged by what's happening at FHA and what Brian Montgomery's doing over there to bring his entire system up to a place that it could accommodate an eNote. Once you get there, I think this whole idea of physically moving documents around like we still do will be something of the Stone Ages. It surprises me that we're even still here, to be honest with you. I'm surprised. And I'll just share with you a little bit of personal experience. This is the 38th year I've been in the mortgage industry. It blows my mind that, we lose a note, right? We lose an original note. And then we call the borrower up and go, hey, Max, hey, remember that $400,000 negotiable instrument that you signed like a couple of days ago? You sign another one. What? And it just stuns me. People go, okay, yeah, fine, send it over. I'll sign another note, right? And it's not carelessness, by the way. And I don't think people are looking at it lackadaisically. I just think it's the system of a physical piece of paper moving its way through the system, and it gets ground up in some copy machine or lost in some snowbank or, whatever, right? So the concept of data security and the discussion about how concerned we are about privacy, it shocks me that we're still here in this paper world, right? And so eNotes and remote online notary and the technology of reducing the cost of the borrower is a time that is way overdue. And I think you're going to see a lot of progress in this over the next 24 months.
Yeah, I mean, look, in the never ceases to amaze me department, I will point out that the only state that has now not approved either a state level statute or an emergency order to enable remote online notarization is unfortunately the great state of California, in which you and I both reside. And the frustration that we've had in trying to understand why California, who seems to have some residual concerns about the data security and privacy for remote online notarization, these conversations that we have, to your point around like the note getting lost, like we've been having these conversations with some people who are like, hey, you are aware that like when a notary does this the old fashioned way, they put that stuff in what's called a notary journal. Like it's a hardbound book that goes in someone's car and then it goes in their house, right? Like that. These same notaries would be happy to not have to drive to people's houses. They can do this stuff online and have this stuff be protected. But anyway, that's that. So I want to leave time for a couple questions. I've got one softball question and that came up recently that I'm actually going to save this one for last because I want to start with one that also came up that is quite timely. And I'd love, as I'm sure a number of people would, to hear your perspective, and then I'll end with a more of a fun one here. And the one that came in here is a number of events this year have put a sharp focus on the need for racial equality. You were the past chairman of diversity and inclusion for the MBA. What do you think lenders can do to better ensure equality of funding?
Okay, so let's talk about diversity and inclusion for just a second. So when I was the chair of the D&I committee, I made a standard line. I was coming off of the previous chairman, who was Dave Motley, who was the former chairman of the MBA. So the process is you are the chair of the D&I committee before you're the chairman of the MBA in the process of your leadership time. And Dave made a comment, which was pretty well reported on, that he thought that the mortgage industry was made up of a bunch of male, pale, and stale people, and people would laugh about that. And that was I think there's a lot of truism to that. And when I got to the D&I, I said, look, I think D&I should stand for diversity and inclusion, but I think it all should stand for should stand for deliberate, and inclusion should stand for intentional. So you're not going to accidentally be diverse, or you're not going to accidentally be inclusive. And by the way, being diverse is a little more easier than being inclusive. It's easier to say, okay, I'm going to make a concerted effort to take a little extra effort to find people that are different than what we typically have hired. So for instance, in California, as you know, the minority is now the majority. So the majority of the folks in California that I'm likely to encounter are going to be Latino or Hispanic. That's true probably in Nevada, Arizona, possibly even New Mexico and Texas and other parts of the country. So it's my opinion that people like to do business with people that they're comfortable doing business with. And I want to make sure that I do something that makes it easier for you to interact with CMG. One of the more difficult projects we've been working on, and it's hard, is to go from the beginning to the end. And when I say the end, I'm talking about servicing, to beginning to the end of a fully integrated Spanish documentation set and communication. And it's easy to go, oh, you just go do that. Well, it's a lot more difficult than you think, because some of the stuff doesn't translate right over. And we've been working on this now for more than 2 years. We're almost done. We believe it's an edge. It's going to allow us to be able to go into marketplaces that we may or may not be in today, but I also feel like it's the right thing to do. I think that I like the concept of things being diverse in my company. I like the concept of things being diverse in my leadership team. And I like the concept of my marketplace being diverse. It's actually sensible business when you start talking about diversity in the manner to which you do business. So look, if you only do jumbo loans and then suddenly jumbo loans go away, your business is going to tip over pretty easily. So build a wide base. Figure out a way to do business in either parts of the country that you don't do business in, or product that you typically don't work on, and then try and diversify that way, but also diversify with the players and the people in your business. Lastly, as I mentioned, the deliberate and intentional side of this thing. I'm duly surprised how much better we have become as a company when I am adding this level of diversity. And diversity, by the way, isn't just ethnicity, it's diversity on locality, diversity on lifestyle. It's all kinds of things. I mean, we're in the Bay Area, so this is a pretty diverse area in the Bay Area. I mean, for the most part, anything goes as long as it doesn't hurt somebody else, right? And I like that. I really do. And maybe there are other parts of the country that aren't as diverse, but I really do like that here in the Bay Area. And so with that in mind, we've been able to bring in younger people. We've been able to bring in people that are from different walks of life and from a different perspective. And those things have opened up our eyes to different ways to do business, not just from a technology perspective, but a way to communicate better, a way to market, a way to keep in contact with people better. I'll leave you with one last thing. If our industry is focusing on D&I, and we should be, by the way, we should also be focusing on the other I, and that's innovation. And the innovation component is what are we going to do? What products do we need to create in order to be able to be competitive in the marketplace in the future? So sort of weird, my world, I live 6 to 9 months out. That's my place I live. I want to know that in 9 months from now, what are my people going to be selling? You know, are refinances dead? Are we back to purchases? And are we looking at second mortgages now because nobody wants to touch the 3% 30-year fixed rate mortgage and they need cash out of their home? In other words, I'm looking out there. A lot of times people have good ideas. The industry is where the ideas will come from. A lot of people have good ideas. They just don't know how to get those ideas implemented. And my recommendation, I'm not trying to make a public service announcement here, but my recommendation is to contact folks like you, Max, and say, hey, listen, who do you know at Fannie or Freddie or Ginnie or FHA? I have an idea that might help people who have student debt be able to buy a home. Or I have an idea that can help you crowd source your down payment. And while you may or may not have the contacts that I have, having sat in the chair of the MBA chairmanship for 3 years on the leadership ladder, but you have them, Max, and there are other people that do have them that you know. So my recommendation is if you're listening to me have an innovative idea and you want to figure out a way to implement that idea, pick up the phone and call either the folks at States Title or possibly an MI company that you're close with, because that's what's needed today. Innovation beyond simply where we're at today. We need to take this entire industry to another level in terms of reducing expenses and exposure. And frankly, again, that diversification of the marketplace.
Great answer. And so I know we're just a little over time, but I still want to ask this one last question because it was a little bit of a softball, and I'm guessing I can see just based on the last name of the person who's asking this question that I'm guessing they may know you pretty well. And so the question here is, what is your favorite Nicolas Cage movie?
What is my favorite Nicolas Cage movie? Well, I think this answer will surprise you,
okay,
as well as surprise the rest of the people in attendance. My favorite Nicolas Cage movie is Animal House.
Really?
Most people are going to say, wait a minute, I didn't know Nicolas Cage was in Animal House.
Yeah, I have seen Animal House several times, and I don't remember him being in that movie. What?
You'll have to do your research, but in the movie, he is not Nicolas Cage in the movie. He is whatever his last name was. It's Nicholas. I can't remember. His actual name was. He changed it to Cage.
Well, I'm just curious. Do you remember who is he in that movie? What?
He's like an extra. He hangs out with Spicoli in the smoke-filled van, which is a perfect start for that.
But that's Fast Times at Ridgemont High, though.
That's no, I'm not. You're right. I'm sorry. Not Animal House. Fast Times at Ridgemont High.
Okay, so he's in Fast Times at Ridgemont High. Okay,
Right.
Another movie that I've also seen a number of times, and so I'm going to go back and rewatch it. But anyway, Chris, thank you for making time for this. Always a pleasure. Many really insightful pieces of practical guidance and advice for people in our industry, and wanted to just say thanks again. Really enjoyed the conversation.
Thanks, Max, having me. And as to follow up, because I have this information sometimes at my fingertips. It's Nick Coppola at Fast Times at Ridgemont.
That's right. Yes, that's right. Coppola, because he's related. He is also related to Francis Ford Coppola. Yeah,
I think it's his uncle.
Yeah, interesting.
Well, awesome. Thanks for having me. I'd be happy to come back again if there's either another major fee added to our industry, or if you would like to talk about some of the other great movies of the 1980s.
For sure. Awesome. Thanks again, Chris. And that's a wrap. We'll be signing off. Thanks all.